Thanks, everybody. Thanks, Ian, for being here. I'm glad to be part of this again. This is an awesome club, and it's always a great time to be part of this wonderful community and to collaborate on ideas. For those of you who don't know me, my name is Maj Soueidan. I'm co-founder of GeoInvesting, and just please be aware of my disclaimer here that nothing here is investment advice. I will do own a position in the stock I am going to talk about today. Do your homework, and by viewing this, you agree to my terms and conditions of GeoInvesting. So again, I've been a full-time investor for 30 years. And I co-founded GeoInvest in 2007 to kind of bring some of my experience I've got kind of culled over the years to other people. It was a free service at first, and eventually went premium with it. And I really enjoyed my ride. And I kind of agree with a lot of what people said out here today in terms of collecting experiences to kind of really improve your strategy over time. That's really what I've done over time. And I just love love being a micro-cap investor. I love investing in small companies and understanding that there's also opportunity out there. And the crux of what we do here, I think we all do it, is just we love the micro-cap market because it gives us opportunity to kind of hunt in a place where it's not as competitive, maybe. And even if there are other great investors investing in the space, we all have different strategies the way we approach things. It always amazes me as, I might hear an idea from somebody and vice versa, and we might not like them. But they might be great ideas. And that's what I love about this space, and I love about investing in general. There really is no right or wrong way to, I think, invest. If you kind of align with what you're doing and everything, have a process. So, a lot of, what I have when someone asks me what my strategy is, and I really think about it, it's everywhere, really. I'm looking for great opportunity in areas I can understand where I've just had great experience over the past, and implementing them. There are some areas I avoid, and I'm going to get into that in a second, but in general, I'm just looking for great opportunities and lots of different stories. And that's why I think it makes micro-cap investing exciting. So, just real quick before I get into the strategies, a little bit about GeoInvesting. We have a really wonderful catalog now of 14 years of research, that a lot of organic research, most of it that our members use to help, kind of spearhead their research. We're very active with our community, sending out emails in the morning, every morning, weekly updates, monthly updates. We have research reports. We got small little kind of, we call reasons for tracking kind of reports. That we do. We've been doing a lot more live interviews and fireside chats with management teams. We also do morning updates with teams when they have earnings, just to kind of give us an idea of what's going on. For like a little short clips here and there. We wrap it all up with a monthly forum where we talk about what happened in our universe. It's usually an hour or 2 hour kind of conversation as we go through all of our stocks in our universe. And we also have some hand-picked contributors that bring us ideas on a pretty routine basis to the platform. So it's funny, as I've evolved, I ran the website for a few years now, and if you ask me how to describe GeoInvesting on day one versus now today, it's changed a little bit, and really now we're really, and this is most important now in this environment we're in now, we follow what we want to play this tier one kind of universe. We call it tier one quality universe. And by the way, that doesn't mean we're looking for companies that are tier one quality. They have the potential to get there potentially too. And that's sometimes where I like hunting the most, actually. And ugly companies that are going to get to these kind of maybe beat these criteria eventually. So I'm looking for, and I'm just going to really list them real quick without getting too much into them. Those companies with a long operating history. I love these companies that have been around for a long time, 20, 30, 40, 50 years. Because they're real companies, a lot of them, they might not be run efficiently, but they have a great markets, that great presence, maybe great customers. It just takes a little bit of change to kind of maybe inflect that growth at some point. Of course, strong management, that goes unsaid. We look for management teams that are focused on the business, not so much a stock price. Of course, you want management teams to want the stock price to go up, but we don't like superficial kind of pump and dump, kind of, overly bombastic press release. So we're looking for more of, hey, how you're looking to maximize shareholder value. You're going to buy back stock. You're returning, capital to shareholders. These kind of exploring strategic alternatives. These kind of things. That's a better kind of, I think, way of looking at how I want a management team to look at the stock price. We're looking for companies that are generating revenue. We're not looking for, development stage companies. We like them to be at or near profitability in most cases. I mean, there are some situations where if they're a recurring revenue or SaaS company, we'll tolerate like a break-even type of situation, as long as they can grow without having to raise too much money. When we do look at probability turnaround stories, this is one of my favorite areas to kind of play in. We're looking for high probability turnaround stories. And the idea I'm going to pitch today, I think it falls into that category, really. Obviously, we like high interest ownership. We like a manageable debt burden, but again, we like companies that might have a big debt burden that there's going to be ways that they're going to reduce that debt burden over time, because a lot of people will ignore those stories. So we're trying to maybe fool the market there sometimes. And ability to grow without excessive dilution is really important to us, without having to raise money all the time. And shares outstanding are not excessive. I understand it's about value, right? It's not just about the share outstanding, but the outstanding share count kind of gives me a window into the soul of the management. Like if I can find companies that haven't diluted over time, that's really a really good sign. So when I look at those small shareholder outstanding share counts, it kind of gives me that kind of starting point. Those that have had a lot of outstanding shares, maybe it's showing that they have to keep issuing shares because their business plans to keep failing along the way. Someone else is sharing their screen here, guys.
Sorry about that.
Okay. I think that there might be a.
There you go. Go ahead. Could you pull back up, Maj?
Pull back. Okay. Let me get it here. Here we go. Cool. Probably a better picture than mine, by the way. No.
Sorry about that. Go ahead.
That's okay. So as we move on here, so an example of, again, I want to stress again, I don't want people to think I'm looking for just incredibly clean companies. Of course, if you go find a clean company that's undervalued, and it's more of a chance of finding that in the nano cap space than the big cap space, that's great. But I love the dirty companies that turn, that can get cleaner. And BXC, I think, Blue Links is one of them. I pitched in the club, one of my first stocks I pitched. Did pretty well, and it was maybe around $10 or so, and everybody I talked to hated this company. This is a really old company, building supply company, lumber, almost bankrupt at one point, and they've been telling the story of the restructuring story for many years, since 2009, when we came out of the global recession. And I interviewed management and just believe the story. And the whole one thing I keyed on was if they can pay down this debt, or if they can not only pay down the debt, but there was also a controlling shareholder that was owning a lot of the stock that was preventing them from kind of doing everything they wanted to do. He eventually got out of that company. So those two things combined worked. They catalyzed, and the shareholder sold the stock in an offering around $7 a share. And then immediately you saw some insiders buy some stock. A few months later, they made an acquisition. The stock went from, I think, like $12 to $45 in one day. You'll see the chart over here. And I sold it here, and they came back down and went back up. But that shows how you can look really ugly and still succeed. Now, I have this is, in housing, they depend on housing starts, so I'm not investing in the long term. I didn't. I got out of it really short. But this is a typical company I probably wouldn't have invested in had it not been for that opportunity. I don't invest in these very cyclical companies, but there was that really special situation that I thought warranted it. So I will look outside the box of my preference, buckets too, often. If it's when you size your bets accordingly. And then I'm all about sizing bets. If I love a company, I'm pretty high conviction. I go in it pretty hard, pretty fast. But I have a longer tail where I have these little small companies I'm waiting on to percolate here and maybe do well. So into my strategy bucket. So the core, of course, I guess you can call me a GARP guy on the core. I love finding. I don't have to find stocks that are growing 100% a year in revenue growth. I like these 10 to 15% growers in top line if I can find them, with lots of margin expansion. I'll buy, I'll look at stocks that are pulling back. I'll look at momentum stocks, clean capital structure. That's kind of the core. If I can find these companies that are clean and in these buckets here, that are undervalued, fine. It's not easy to find, but if I find them, I love it. But so I'm usually hunting in this area here, these kind of strategy buckets here with special situations where I'm looking for, event-driven catalysts, balance sheet restructuring, M&A situations, whether it may be particularly a target, or we'll do some reasonable acquisitions to kind of catalyze the growth of their current, organic business. I love buying stocks that fall on non-dilutive offerings. A lot of times you're getting a shareholder out of the company, like a BXC situation. I love business model restructuring. We saw a lot of the situations where you had companies going from in the software area from like to more of a SaaS kind of model, which was a great kind of thing to exploit for many years. And then we look at stocks where there's maybe some interesting shareholder activists getting involved sometimes to maybe help turn a company around. And then finally, I love these long shots. I love investing in stocks that are penny stocks under $1 that are just misunderstood. And for some, there's a lot of tier one potential in these penny stocks. And I think that's where I think a lot of us had some of our biggest gains maybe because they're the most ignored and everyone thinks they're all, pieces of crap. But, I think, I don't define quality by the price of stock. I define it by the quality of business and the potential for the future. So that's where I place a lot of my bets there too. So when I first started investing, I was really all about short term. I think I based everything on fundamentals. Even when I was a short term investor, I was looking for companies that would where there was going to be like a really good growth momentum for maybe 4 to 6 quarters or so, and I would ride that and get out. And then over time, after 2008, that strategy wasn't working as well because there was not really a lot of demand for our smaller cap companies. You had to hold them longer term. So I had to really kind of shift my strategy a little bit and think longer term because I had to hold these stocks longer term. So I wanted to know the risk I was going to be, getting into. So I pivoted a little bit then and became a much longer term investor. So now I have a portfolio. My top 5 or 6 companies probably are really these stocks I want to hold for a long term. And around it, I have these short term kind of bets that's still on my whole strategy. So it's kind of cool to have both things going on. I calculate this thing we call the Geo Power Ranking, which is we try and figure out if we can find a median of a growth of a cycle of a company. Can I get a 4 to 8, 4 to 6 kind of run in earnings? And if the stock is undervalued, I'm going to want to maybe buy that. So that's what the GPR is at 11. And I think it wasn't really working well. It worked really well for the first 20 years of my career. Then we went into the 2008 recession, came out of it, didn't work as well anymore. Now I see it working a lot. Now that we are in a new environment now where earnings matter again, you can't throw darts. It's not everything goes up. I think this is really going to work really well. I think investors have to care about earnings. That's a new mindset. So I'm really excited about this part of my strategy coming back so I can have a long-term and short-term type of piece to my strategy that's going to work, hopefully. And then, so again, I make a list of all these, I've been doing this for so long that I always make these, I make a list of multi-bagger trades I came across. I also make a list of red flag stuff too, which is not on the slide here today, but because that'll be a lot, that'd take too long, where I went wrong. But I try to focus on the positive and find out, some of the areas I like that tend to be the most chance for multi-baggers. And it's increased wallet share, getting more revenue for your customers, strong operating leverage, growing earnings faster than sales, small niche markets that isn't going to attract a lot of attention. Early stages in the market expansion cycle. I love that. Shift to recurring revenue models, improving capital structure. We talked about that. Examining market trends as it plays in the company's strength. So, for example, what does that mean? It means now we have a little protectionism going on in the world, right? Where everything's coming to the U.S. We're not companies want to outsource as much to outside the U.S. So there's a lot of companies that are going to benefit from that type of trend. So I'm looking for companies that have large market share presence in the U.S., for example, that have a lot of competition from China maybe, and that competition is leaving. So that leaves a really nice playground for them to pick up, some more easy market share. And then of course acquisitions. Not only that, just add revenue and earnings, but I want these acquisitions to actually be synergistic with the company itself. I hate seeing these companies we'll buy acquisitions. but then they don't do anything to the base business. I want to see those acquisitions not only growing, but also helping the legacy business grow also. And that kind of works with the wallet share situation there too. And a lot of times you'll see a company will be acquired, then that company can help get more revenue from current customers for the company. So those are some of my things I look for. So again, in closing remarks, I'm a concentrated investor, have a lot of stocks, small positions on the long tail. I do short-term and long-term investment horizons, and I avoid areas I don't understand or that I don't have a good deal of, or that don't have a good deal of, they have a deal of predictability, such as mining. I don't understand banking too much, so I don't play in that too much. So I don't like to invest in commodity stocks, oil stocks. I missed that big boom, obviously, but that's basically it. So let's move into my pitch today, the SPAR Group, SGRP, and this is going to be not your typical microcap company. You have 70 million revenue. They've been around for 50 years. We're going to get that in a second. But when I was looking at this company, I like to read conference call transcripts all day long, and I compare them with the press releases. And if, because we focus a lot at Geo on information arbitrage. We're trying to find all this misinformation in different sources in the MicroCap land and put it all together between SEC filings, press releases, and conference call transcripts. Really not that complicated if you put the time in to find stuff. So I came across, this transcript of the company. I think it was maybe Q4 of last year. And the CEO, who basically joined the company, I think in February 21. If you gave me 100 chips to place in the business, I pushed them all in on SPAR. And then I came across this wonderful passage. Given the recent volatility in the markets, we believe investors will be searching for growth at a reasonable price. We believe that SPAR's investment thesis provides investors with compelling investment thesis to consider. So this guy's touching on the things I want to invest in, and I like that he understands what kind of market we're in. And what he's saying there, I really believe in it. So now I'm trying to this is a company I just kind of came across not too long ago, actually a month ago. And I'm still really early to due diligence, but I don't have a great handle on like the growth prospects, 5 years from now. But I like the position of the company in their markets, and I'm going to get to in a second. I like the CEO kind of approach to how he's thinking here, and you'll see that as we move on over here. So what does this company do? So these guys, I guess it's pretty boring. Merchandising and branding help the company. So either brand marketing or to retail locations. So you think of when you go to a CVS and you see someone stocking the shelves, that could be them. If you see a retail operation opening up a new location, they could be there in the grand opening, helping to get things right, pricing right, branding, the displays, all these things. So it's boring, but it's needed, and it's really I think it'll be more and more of in demand as we move forward, especially if we enter in a recession or tougher economic times. You're going to see companies laying off people, probably maybe in this area, and why not outsource this to those that are experts in doing it, and use your employees to do better things that they're better experts at. And I think that's going to be a growing trend as we move forward. So now why I'm excited about the company is this legacy business, and I'm going to get that in a second. I think there's a lot of opportunity just in the legacy business that this new CEO is going to try to exploit. But they are going into new areas, and I like that. I like that about the story too, because it has, not only do I think it has interesting stuff on the legacy business, there's stuff going in the future they're going to be doing that could be really nice little optionality to it. And they're looking new areas of focus of ways to get that analytics business going, where they're kind of helping these companies make decisions quicker, branding, pricing, inventory decisions quicker on the fly. Part of that is they've had this cool thing that's like a crowdsourcing thing where they're actually getting pictures in real time of a location and getting feedback right away to the customer, to the retailer. And they're doing that through crowdsourcing through like shoppers and just other kind of AI things. And they also want to maybe they're getting into fulfillment services. So they're just trying to, if they're already touching the customer, they're trying to figure out how can we do more things if we're already touching the customer. And fulfillment services is a natural extension of that. So we move on here. I'm hitting the stock price of $1.47, market cap of 32 million. You can see all the stuff over here in front of you. Shares outstanding only 22 million. Now, this gets the complex of the story here is they have some about 70% of their business is in the U.S. The rest is overseas, these JV partnerships. So it makes valuing it a little complicated. So I'm not really concentrating too much on the valuation right now. I mean, all that they do have, I think, an EPS right at 21 cents, PE of 7 on that, 4.7 time adjusted EBITDA. I just think it's a reasonable valuation, even though it's early in my process. This is one of those long tail type of situations I'm looking at. I want to buy this and have my portfolio. And you're going to no debt. They have 12 million cash, and I'm just still calling through the story a little bit. But I think what I'm doing here, I think I'm buying the story at a reasonable price, with very little downside and lots of upside if things go right. Moving forward here, so as you can see here, now this carry is one of my most favorite multi-bagger traits. It's wallet share gains. I think this company has an opportunity to get a lot of revenue from its current customer base. As you can see here, you got CVS, Dollar Tree, you got Target, Red Bull. I mean, then the list goes on and on here of great customers. This is just a typical situation I see in a lot of these older companies that have these great kind of brands as customers, and just can find great ways to maybe get a huge revenue lift just from them. And in this case of SPAR, they can gain more location accounts from a brand. So if they're doing a brand in one store or one geographic area, they say, hey, well, why don't we do you in Michigan too or something? So they're concentrating more on that. So where they're having success with brands, they're trying to expand with that brand to other locations. The upsell services, they do a lot of merchandising kind of services, and they might not do them all to a particular customer. Cross-border international expansion. So the same thing as the gaining more location from accounts from brands. So they're having success, for example, in Brazil, where they have a JV with a particular brand. Why not try that? Why not go to the U.S. with that brand and say, hey, you can do it over here too? And introducing new services is also a thing they can do here to their current customer base. And what's interesting, I had a little brief conversation with CEO yesterday, and he said, these are, when he came on board in 21, he was amazed that the organization wasn't really focused on this. So he's really made a really good attempt to really get the staff and the employees on board. Hey, customers are asking us for this stuff. It's for more, and why we haven't given them more revenue opportunity, more of these services. So you need to be more aggressive in being out there. It's out there to get. So he's having some early success with that right now too. So HHS, Hart Hanks, is an interesting blueprint. It's a similar industry than SPAR, and their CEO came in the company a few years ago, and the stock has gone from $3 to I think $14 today, based on just doing the same thing. They have a fulfillment service. They had a customer service area, and they had a digital marketing area, and they just basically went and just cross-sell the hell of those divisions, and then they to their current customers and upsell services, and it was just a blueprint that worked really well. So I thought that was interesting. It's in the same industry to some degree in some areas, and basically I think SPAR is trying to play the game. Now let's go real. It doesn't meet my tier. It meets probably 8 of my 10 criteria. Been around 50 years. Strong management. I'm still fact checking. I didn't give this a yes yet. That's why I have 8 here. It's one of the ones that didn't meet. I'm still fact checking the CEO's claims and what he's done, but he seems to have really great history in the retail space and helping turn companies around and building companies from scratch. So I'm pretty optimistic about putting that to a 9 soon. Management focus on the business, on artificial stock price movement. He came in already authorized a share buyback. They're already exploring strategic alternatives as of last week. Put a press release out about doing that. They're generating real revenue. They've grown from 119 million revenue in 2015 the 256 million in 2021. They've been profitable for 4 years. Maybe not growing, but I think they're going to grow. But they've been profitable, steady profits, and that's why I like this. This is a situation. It's not even though they meet a lot of these criteria here. There's some pieces of it that aren't great, sexy to investors yet. Sure, they're profitable, but not really growing a lot. And they're just maintaining profitability. And I think that's a big key here. And I think once that starts to play out, that you'll start to see more investors come into this thing. Moving on over here, high probability turnout rate. That's definitely yes, because of this. What I talked about earlier, basing the wall share thing, is it makes for a great turnaround story. I don't even know if I call it turnaround, but definitely it would fit there. This is a really big note here, higher insider ownership. So 50% of the company is owned by the co-founders of the company, who are not friendly, by the way. And only 1% is held by who I would call friendly. I should say friendly, by the way, friendly hands. And I wish there was some more insider buying by management. So that's something I'm taking up with management and finding out why the hell they're not doing anything there. Manageable debt burden. Yes, they have very little long-term debt. They get 12.1 million cash, current ratio 1.38, and days receivable 83. This is pretty cool. The ability to grow without excessive equity raises. Shares outstanding have only gone up, a couple million since 2000, from 18.3 million to 21.9 today. And shares are under 50 million, so that meets that criteria there. Let's get this really quick here. So the CEO was appointed in February 21, and immediately he took action to basically the co-founders of the company, the majority shareholders, were basically handcuffing the growth initiative of the company. And he entered an agreement with these guys to basically relinquish control of decision-making things for to help grow the company that the company wants to do. And he inked that, I think, in 21. So that basically is gone now. That was great to see that. I don't want to get into what these co-founders were doing. You should probably call it, if you're interested in the story, call the CEO and find out some of the things that were going on that now are not happening, which is going to be able to help this company grow and implement the strategy they need to implement here. There's obviously now they limit preferred stock. They put a better corporate governance in. So I talked about earlier about aligning employees with a new vision to drive sales, about getting wallet share. I talked about the 500 share purchase program, 100,000 share purchase program. And CEO, by the way, is very hands-on. I love it. He's all over the place. He's meeting customers. He's traveling. He's making sure that he is on the pulse here, trying to get this wallet share thing moving. They announced a strategic alternative. So I think that these guys could be, is the company for sale? Could they get bought? And interestingly, they've announced a strategic alternative, press release last week, I think it was. And I'm actually thinking Hart Hanks, HHS, could be an interesting candidate there. They definitely play in a similar industry. And I think that the momentum that HHS has now in their turnaround could really, really ignite what SPAR is doing. So I'm going to watch that very, very closely. It also could be a customer experience management company. Those are companies that help companies understand their customers more to help drive revenue. So that could be a potential there too. Another reason this might be being ignored by investors right now too is that the revenue growth doesn't look that great right now. I mean, this year has been good in terms of profitability, but revenue's been flat. If you look under the hood, you'll see that pieces of the puzzle coming together. So even though all of overall revenue was flat for the year, 6 months, the U.S. grew by 16%, which is 40% of revenue. The Brazil joint venture grew 25%. If you wasn't forced some of the China business they have on the lockdowns going on there, revenues would have been up 10% actually for the 6 months. So as that plays out, hopefully it becomes more clear what's going on there. Hopefully investors will find it. I love finding these companies where the consolidated revenue isn't looking good, but under the hood you find some of these kind of successes, some of the things that are going on in some of the other divisions and other areas.
Okay, Maj, you got 1 minute left?
Sure, yep. So the caveats here, right? Could this be affected by a recession? Yes and no. I mean, obviously some of their clients are retail, But I would think also, as I mentioned earlier, I think there's reason to believe that if there is a recession, there might be more reason to think this company will do well. As companies lay off people, they're going to need to still have brand and merchandising efforts, and they're going to want to outsource that. Sales have been range bound the last 4 years, but I talked about that. 19% gross margins are not attractive at all, but I think they're actually closer to like 27% when you factor in some one-time things that are going on right now. I don't love the JV structure. These large legacy shareholders seem to be selling the stock. They want out, which, by the way, could turn into a positive. Maybe that will catalyze the sale of the company. I wish management had more skin in the game. They haven't been cash flow positive for the first half of 2022, but they were cash flow positive in 20 and 21. I think the reason they're not positive this year is because of some of the impact on China on the bottom line. It's a labor-intensive business, so we got to worry about that in terms of wages and things. And I'm still trying to assess if there's what kind of operating leverage is involved with this company. If there's so that's it, Ian. But thanks a lot, guys. If you have any questions, just email me at maj@geoinvesting.com.